Welcome back, folks, for another episode of Redbelly Insights. This is episode number 11, and we've got a really special one because not only do we have the announcement that you would have just seen that we have been waiting for some time, but we've also got Alan here all the way from Europe. Thank you for dialing in, Alan and Arturo. But just a quick recap. We had the Redbelly Insights episodes 9 and 10 with Vincent, diving into what was going on there with basically AI and blockchain, and you would have learned a whole heap of stuff on all of that, as we not only showed you what was over in DECA, the conference over in the Gold Coast, but also a deep dive in the last episode. So that was really interesting to see. This time we're going to dive into the project. So Alan, Arturo, thanks for dialing in. Over to you guys.
Thank you.
Thanks, Mark.
Very
I
good.
appreciate that. I think Arturo. I think congratulations, firstly, but for the most, I guess, leaked confidential project in the world. I think obviously the announcement's been the rumor mill's been working for overtime for a while now, but it's great to finally have the official RBA announcement of not centralized and ultimately Redbelly's selection in the CBDC trial.
Yeah, thank you. It's well, I mean, you'd know better than the rest. It's been a lot of work, and it's been a very interesting exercise for the more unexpected reasons, which is effectively what happens when you're bootstrapping an open capital markets infrastructure, right?
I am familiar with the challenges of working with large risk-off institutions. To be fair here, I think the RBA is taking a pretty massive leap with the DFCRC in terms of being the first central bank money ever on a public blockchain. So other CBDCs have been kind of trialed before, but this is a pretty big step by them. So I don't want to say that they're not being really, obviously judicious in their approach, but obviously this is a big step.
Look, I think that question kind of bounces back to you, Alan, being the chairman of Redbelly. How does it feel to actually be the only public blockchain with a direct relationship and soon to be token from a central bank?
Look, what is actually great is it's almost validating more than anything else for us. So Redbelly was obviously designed from Vincent's ground up to actually solve problems for real world assets. Before real world assets were a narrative, what were the challenges with getting this technology adopted by real institutions and having real high value transactions? Central bank money or the central bank balance sheet being exposed is probably the top of that tree. And so it kind of validates our whole approach, right? Which was, if we think about what they've said that they care about for us, is they care that the validators are known and the actors are good, and that we protect through our proof of fraud and other protocols, as well as kind of the basic identity that they know who they're dealing with and who's executing consensus in a trusted way, and that the integrity of that can be proven and people held accountable. So that's kind of the whole philosophy of what we've done from the start. So it's certainly validating, as we can appreciate with all of these organizations. It's a slow burner. I think it's been really hard to for a community that's used to kind of a very fast moving ecosystem and Web3 space generally, to be working with people. But we definitely understand that these unlocks are very material. If you can bring effectively AAA rated money or sovereign balance sheet, or what's effectively in financial services zero risk, not just zero risk from the settlement because of our instant finality, but zero risk because of the counterparty, you've now got a system that is actually really fit for purpose for kind of institutional adoption.
It's really interesting, right? Because every market is driven by some form of soundbite, right? And RWAs is definitely it's no different there. And we've seen multiple projects of various sizes getting into the RWA bandwagon, right? But I think that what we've been able to show in through this pilot and through the continued work that we've been doing with the partners is that you don't build an RWA blockchain. What you do is that you build an ecosystem that is fit for purpose for capital markets, right? if you then follow through with the ideals, if if one thinks that they're important, of what public blockchains do, and I think that they are, but that at the end of the day, that's an opinion. Um, Building what we have achieved here as a community is quite unique, because not only do we have have we been able to prove that the technology is able to underpin the ecosystem and the flows of securitization, but more importantly, it's also been able to get the attention and the integration of the various service providers that are actually necessary to be able to execute on a securitization flow. So if you take a blockchain that comes and says, look, we have the capability to do X, Y, and Z, many can, to a certain extent. There's a bit of devil in the detail over how it's achieved. And I know that in the overall community, there is question marks around the importance of finality. I mean, in my opinion, finality is a necessary constraint. It's not a sufficient constraint. And that being said, actually, there are very few other blockchains, if any, that do have the properties in the consensus mechanism to suffice. But more than that, it's really been about taking these different participants, like trustees and custodians and liquidity providers and so forth, that don't come from DeFi but actually come from TradFi, and making them comfortable to participate through this new rails. Now, I know that you've been doing this for a while. What do you think is, how would you describe the progression, the change in sentiment from the earlier conversations to where we are today?
Look, I think if we go back to, everyone's understood the opportunity in TradFi, right, or financial services or capital markets. Back to the STO days, right? We had ICOs, then we had STOs, and then that promise never really got delivered, and there was a bunch of reasons for that. The tech probably wasn't where it needed to be from a scalability, performance, and finality perspective, to your point, the base layer. But also, we kind of have these philosophical differences between, anonymous or pseudonymous approaches versus the kind of real constraints that are what I'll loosely call a level of permissioning, right? And let's not use permissioning because it's always a controversial topic, but let's call it eligibility criteria, right? So different participants require different eligibility criteria to be met in order to transact. That's under whatever license regime or regulated market they're operating, whether it's an offering in any different jurisdiction to individuals or organizations that are in a different jurisdiction that operate under different rules, and all the counterparties in the middle that might have different regulatory requirements. We can't solve for that, and that'll never be harmonized. Securities law isn't new, and it's not harmonized today. So Redbelly went about kind of building for that complexity. So even if we look at the crypto market, the more native digital asset space, that market is now becoming regulated through MiCA here in Europe or other things. And so as markets mature, we know they become regulated, and they will have frameworks that need to be adopted and used. And so we always set about making sure that we could deal with that complexity. I think another big key thing in the approach with that is, to your point, I want to talk more specifically about the use case in a moment, but in your example, because you've got such a complex flow across all the counterparties, how do I check for those criteria at each part and still get the composability that I get in the permissionless world, right? So that's why having this credentialing at the base layer is so important to get the end-to-end flow in your very ambitious use case, where we can go from payments to secondary trading with complete look-through, because everyone can satisfy their regulatory obligations in real time at the point of execution across the way. If you think about some of the, you mentioned alternate approaches. The alternate approach is effectively a walled garden on a public blockchain, because there's no other way for that market operator or that participant to meet their regulatory obligations in a permissionless way. They just can't do it. That's incompatible. So they end up wall guarding or permissioning their contract or their DApp or whatever it is, which then immediately makes composability really hard. So by bringing this down, you can now have someone do the payments part, someone do the securitization part, someone do the kind of issuance and offering, and someone doing secondary trading on the same asset, all complying with their different jurisdictional and licensing requirements, which is why we can unlock, to your point, an open capital market infrastructure that anyone can just jump on and participate with all all the things that they need to execute those flows, ready to go. I think, to that, you did mention securitization. We've mentioned that a couple of times. I think this is, and I'll call it already, as you said, we've got a couple of different use cases coming up, but this one I think is the most ambitious and the most complex across my understanding of the whole RBA spectrum, because most are kind of dealing with a particular point solution, whereas you are really bringing a bunch of parties together from the start to the finish of the workflow. Could you just explain to us what securitization is and what that kind of flow in your use case looks like?
Yes, securitization is a term that people use quite loosely. In principle, I think that what you're trying to do through securitization is financializing things. All right. So the more technical definition, where people usually, in finance think of securitization, it's the creation of an asset-backed security, as an example. So what happens there is that you have a bunch of, let's call it real world transactions, that in a general sense are effectively receivables. So it's promises to receive a payment in the future for whatever reason. May that be an invoice or a mortgage or, everything that you do usually that is a financial relationship has some form of payable or receivable attached to it. Now, when you securitize, what you do is that you take these receivables and you offer financing to them, right? So I am due an invoice in 30 days, but I need to have payment today because I need to manage my cash flows. Then I could just factor that invoice. Or if I need to make a payment, but I need to manage my cash flows, then I could finance that payable. Now, the action of taking a number of these factored invoices or factored or financed invoices and pooling them together so that I create, let's call it a fund or a group of these payables. I then link a security to it or a number of securities to it so that I can go and raise capital from the bond market, for example, or the debt market or one of the various capital markets. That transformation of risk from utility to capital to money is what securitization is. And to a large extent, that is what financial markets or financial relationships are about, right? It's about connecting things. So unless you prove and show that you can represent a full value chain on chain, then all you're doing is that you're representing pieces and you're always dependent on connecting through APIs and relying on the accuracy of things that you cannot verify because they're not on chain, right? So I think that's what we're really doing here is that we're laying the foundation for what the RBA effectively wants to prove, which is, do tokenized markets add value, and how can they support tokenized markets? So it is ambitious, but I think that it is going to the core of the reason why we're actually running this entire pilot, right?
Look, I agree, and one of the big questions that we always still hear in the space is about blockchain still just looking for something to solve, right, or a tool looking for something to solve. What I love about this, and it only works with the level of ambition that you've managed to do here, because your point is right. It's only when I need a trusted single source of truth across untrusted counterparties across a value chain that a blockchain becomes really valuable, or the only way it could be done. So, if you think about the participants, and I might get you to rattle them off quickly, but each of these participants effectively are running an individual ledger of their piece of the pie and facilitating the payment of their part of that ecosystem, right? And so at the moment, it's all a bunch of black boxes that are kind of strung together, and the integrity of the data that underpins it, and the timing in which it takes to kind of flow from start to finish, and that information is and the reconciliation that's required between each of those boxes, while might be trusted or regulated, is still slow and expensive to execute. So I think this is really ambitious, but it shows why blockchain, firstly, and secondarily, kind of what the real saving across that value chain can be in the efficiency dividends of programming the rights and obligations and the ledgers at the various points. So maybe just kind of give us a quick walkthrough as to who the participants are and what their roles are, and if you can, what the benefits are at each of those points for that participant.
Yeah, well, we in the spirit of complexity, because it is a research project at the onset that then becomes a proper commercial project. And I think that it's important to acknowledge that, because it is real money that we're dealing with in this scenario. We're actually running a pilot that is tightly connected with Fireblocks and their pilot as well. So what we're doing is that we're connecting an investment flow with an asset flow, and all of these are tightly intertwined, right? So we have obviously the RBA that sits there and offers the CBDC, or let's just call it the money, the money represented on chain. And the reason why that's super important is because settlement risk is multifaceted. It's not only the risk of you not getting what you're supposed to get, but it's also the risk of this thing that you are paying with or that you're getting stays of the same value, or has the expected value that you think that it's going to have, right? So if you're paying with commercial bank money, then you're obviously exposed to the commercial bank's credit risk, which at times is not negligible, and therefore you have credit risk and settlement risk to a certain extent, right? So the CBDC actually facilitating and offering a way for the market to execute in a credit risk-free context is it is necessary if you're going to do this in a serious way. So we have the RBA offering this facility. We then have a commercial bank, ANZ, that has, as all commercial banks, a relationship with the RBA, and then offer a stablecoin that is used to transact for the non-bank counterparts. So in this scenario, the non-bank counterpart that is purchasing the asset is Fasanara, and they are their role is to get the stable coin so that they can purchase a bond. And this bond is purchased through the Australian Bond Exchange. And their role is to make a market, to offer the opportunity for price discovery, for asset discovery, for the settlement of that asset. So they, like all exchanges do, that's what that is their role. And they then jump and connect to their existing counterpart, which is Perpetual, which becomes the trustee for the issuer of the bond. And interestingly, we're actually making a distinction in this scenario between two separate trusts. So let me recap the investment side. We have the trustee that issues a bond. That bond is listed and transacted through the Australian Bond Exchange by the investor, that is Fasanara, that is buying the bond using a stable coin issued by ANZ, and that is backed by a CBDC that is issued by the central bank. Usually, most tokenization projects stop there, right? It's about representing an asset on chain, like a placeholder, effectively, and representing that transaction. That's only half of it. The other half is actually the asset, right? How do you create an asset of better quality that does exactly what people are used to, but in a better way? So we have Perpetual creating the bond through a trust, but then we have another trust, which is managed by AML. And in that scenario, this trust is the asset trust. So this trust is the one that aggregates, creates a pool of assets, in this case, invoices that are originated through payment services within construction and within other different industries. But the key in reality here is that you have an asset pool that acts as collateral for the trust that backs the investor, right? So the reason why we're making that separation is because we want to show that the properties of synthetic collateral, i.e., the ability to move collateral through synthetic financial engineering, can be achieved through a blockchain in ways that are much safer. Because the thing with synthetic collateral is that you have trust one and trust two. Trust two takes beneficial ownership of whatever it is that exists in trust one. But usually, when you're doing synthetics, you just have a commercial agreement. It's a contractual agreement. So you don't need to see what exists here, right? And that's how banks work. And it's really efficient until it isn't. And then things blow up because you can't see the risks that are in the system.
This is a great example of the of what happened in 08 with the mortgages, right? So
Correct.
one, who was holding what? The ledger of the trust on this side, like who has what, was still paper based and phone call negotiated, and on the other side, no one knew what they were holding or the quality of the asset, or how to impair the asset. So both sides of the ledger being separated kind of exacerbated that problem. So one, they didn't have a single source of truth ledger, and two, and for any of those trades that were being made by paper and phone and email, and versus what we can do today already, which is kind of understood. But on the other side, not understanding the quality of the asset, let alone being able to originate a better asset, is kind of a concrete example we all remember that of where that didn't work as kind of well as intended, right?
Yeah, absolutely. And even when it works as it's supposed to, in the traditional world, we have this massive elephant in the room that nobody actually talks about, but people spend hundreds of millions of dollars trying to not solve, address, which are two very different things. And that's reconciliation, right? Nobody's actually trying to solve reconciliation. They're just trying to address reconciliation by adding more sticky tape and more and more and more and more and more. And then all of a sudden you end up with, the big banks in Australia alone having spent hundreds of millions of dollars in projects to streamline things. And many times, because it's difficult to manage thousands of developers over long periods of time, they're not necessarily failures, but they're not great successes, right? And what we're showing with this value chain is that because we can program these relationships on this shared ledger, then we can achieve reconciliation by design within the ledger itself. And I think that's the magical piece that you only really appreciate if you've been, if you've gone through the pain of actually trying to work in traditional finance and trying to solve that life cycle management of a product and understanding what goes wrong and the exception handling that is necessary to fix those issues, right? So again, going back to RWAs and the the sound bites that many people talk about. Oh, we've tokenized X amount of real estate. No, they haven't really. What they tokenize is a lien. It's a unit of a trust that is linked to the real estate, but the value of that thing is not only the real estate, it's also the cash flows, right? Because when you buy into real estate, you're expecting a yield, but that yield in the standard tokenized environment is done usually completely off chain. Whereas what we're trying to do is tokenize that payment point. And when you tokenize that payment point, you are creating an on-chain native structure for the entire set of cash flows and product and value chain. And therefore, you let the programming deal with the reconciliation. And that's really, really a massive next step.
Yeah, so really you're combining a payments use case with kind of some contractual obligations between the participants at payments and whether they're complying or not with that, and that's all visible on chain. We then take those receivable or obligations and then package them into a pool of a trust, which you can also then see and validate the value of and what's in there and how it's performing before selling that bundle across to another trust, which then eventually fractionalizes that out for sale. And I imagine we're now also automating the yield that happens or from those payments and those obligations right through to the holder, which I think is a whole separate problem today, right? Like, though that's actually a completely different flow generally, the distribution flow or the yield flow from the asset ownership or ledger perspective.
It is, and I think that it's also worth discussing. You know, we've had this conversation multiple times, and I think that one of the reasons why it's such a fruitful relationship is that we actually care about what the end customer needs, and it's less so about how do we make sure that the technology fits the needs, as opposed to what is the best experience for the customer, right? And when you talk about tokenization, and you limit yourself to thinking about the execution, which is effectively what is the token representation part of that user experience, then you miss out on the full solution that we're actually trying to deliver to the customer, right? So, what are we actually talking about here? We're talking about communication. We're talking about a new tech stack that supports the way in which people are going to be running their financial flows and doing the life cycle management for their financial relationships and obligations, right? So it's being built today. There is no technology today that should be built without the support or embedded design of what agentic workflows
Right.
do, right? So this project is really one of those incredible scenarios where, going back to the premise of Redbelly, which is open capital markets, allows us to show what open capital markets should look like, right? They should settle on an immutable shared ledger. They should be powered by and supported by an ecosystem of agents that support what people are doing, but still give agency to an individual, right? So a framework where individuals take sole responsibility for what happens, even by their delegates, i.e., these agents, but the interactions are just much smoother. Because there's no reason why you should effectively have an email trail of 10 emails being bounced back and forth between individuals over relatively standard questions, that agents can effectively just support and communicate much quicker, ideate, and get to a right structure or right idea that is then agreed upon, or let's call it signed off by an individual, that then triggers an actual settlement of value transaction, where the way in which you control the behavior that these agents are meant to or intended to execute is done by policies, and these policies are immutable, and these policies are living in a place where it's highly deterministic, right? So, i.e., a blockchain. And it's very rare that you get the opportunity to actually reimagine and build things from the ground up. And I think that a great example of that is the Swift network, right? The Swift network has become what it is because there has been a problem that still exists, which is that banking systems are built on Cobalt from the 70s. And there is no natural communication between them. And there's batch processing, and there's all of these things that were necessary back then but have remained. So all of a sudden we have Swift that sits on top of it and is a messaging system that is supposed to unify and standardize the way in which we execute these operations. But
Well, a lot of people don't even understand, to your point, Arturo, that even that isn't a direct messaging system, right? That gets relayed sometimes, right? So some regional bank goes to some major bank to then go cross border to then go for another bank. So it's not even that it's a direct point to point solution here or a single source of truth. It's actually relying on a bunch of intermediaries to provide trust and liquidity on the way through. Hence, it takes so long. And I think that's your point, is why we've seen such a massive uplift in stablecoin, or what people are excited by about that opportunity. I don't want to cut you off, but obviously I think that whole stablecoin space is another really neat tie-in to how will a world exploding in stablecoins keep their peg? How are all US dollars created equal? I mean, you touched on earlier that that really it's a liability on a bank's balance sheet, right? It's actually it's not actually a coin. And then we get into, and we saw recently JP Morgan launch a tokenized deposit on Base. Again, distinct from a stable coin. So we're still not even clear about what all these instruments are, let alone how to value them, let alone are they worth $1, let alone will I accept token A or token B, and am I going to have all these pairs? And what, to your point, does that do to the user experience if I've got to get from, even in dollar terms, different flavors of bank or non-bank private money to settle something? And does that change the liquidity profile or price discovery even of my asset based on what I am or not paired against, right? And how do I get in and out of that? So I think, further to what you're saying, I think let's continue the Swift conversation. But Swift kind of happens to message between banks where there's a bunch of assumptions that are, let's call it off-chain consensus in central bank world, to kind of back that peg in, right? Because even today, a bank dollar isn't a bank dollar isn't a bank dollar. They are liabilities. Why we all accept that they're just one currency from a bank is that, frankly, the central bank underpins all that, right? And so what we have is obviously, one, a banking guarantee for from the deposits. The central bank kind of underwrite it and therefore regulate it difficultly. But we all just see, a dollar. Whereas in this world where these dollars are tokenized, or these obligations or assets are tokenized, they aren't all created equal. And I think that's going to create, we can all see why we want to get to this more efficient way of transacting instantly, atomically, anywhere in the world, 24/7. We all love the attraction of that. And I think you kind of really broke up earlier the settlement risk versus, I guess, the counterparty risk in the asset and whether it being valuables. This amazing opportunity that everyone's seeing, not just in real world assets, but more a subset being stable coins. I think people aren't yet at the level of evolution that when this explosion happens, how does that even work? Do you have thoughts on what we're doing here and how that does or doesn't help for kind of the singleness of money problem?
Yeah, it's funny because people commonly, I think that people have a general understanding for the difference between their let's call it their net wealth or net asset value and liquid portion of that asset value, and then cash or money, right? Now, what I think that is not really clear is that the amount of money that people actually have is most likely zero, unless you actually have physical notes in a vault at home, right? Everything else is a loan, it's credit. So you actually don't have any money. I personally don't have any money, right? I have everything in a cash. Maybe I have like $10 in somewhere at home because I forgot to do something with that cash, but everything else is sitting in digital form with a bank. So that's actually not money. And if we try to understand from both a credit perspective and a technology perspective, what that means is that in the credit stack, I don't have anything that is of zero credit risk because I'm relying on the credit risk of a bank. From a technology stack, it means that all of my value that I consider money but is actually credit is sitting in a Cobalt database at one of the bigger banks, right? So how do we achieve singleness of money? Well, we simulate singleness of money. First of all, I say simulate because we don't actually have any money. So, the concept already is a bit weird, but we simulate the user experience of singleness of money by creating new things like Swift or these standardized messaging services so that this thing that is attributed to me in a Cobalt database in Bank 1 can be transferred, i.e. burnt and minted through the messaging system that is Swift or MPP onto this other Cobalt database that is in Bank 2, right? So we could, on the one hand, think of that in blockchain terms of saying that, well, we have two separate blockchains that are completely disconnected and they're not standardized at all. And then they have some form of a bridging mechanism on top, which is Swift. Or you could actually think of it as the financial ecosystem being one blockchain with multiple nodes, and each node is completely disconnected and built differently to the other nodes. And consensus is achieved through XML, i.e. Swift messaging. right? And consensus is basically reconciliation on top of the messaging, on top of these Cobalt networks, right? That is consensus. So when we go back to your question that I kind of tried to answer in two different ways, how do we achieve singleness of money, and what are we trying to prove there? And when we start talking about different stable coins, and oh, well, that stable coin is not super safe because it's not actually always pegged to one, or that stable
May or
coin
may not be
lives,
backed. How do we even know it's backed?
correct, it might
This
not
comes up
even
a
be
lot, right?
backed. Exactly. Now, the fascinating thing is that blockchain, because of this intrinsic transparency that it has, actually highlights what we already experience, but we don't see in the traditional world, right? We don't experience that we actually don't have money. We don't experience that we have a bridging mechanism that is actually really clunky, managed by XML, that is trying to achieve consensus between these different nodes that are written in the 70s and have really weird consensus mechanisms. So I think that's what we see is a potential problem in blockchain is a problem that already exists in the traditional world. We're just actually solving it because we're acknowledging the problem in the first hand, right? So, for example, you talk to exchanges and you say, well, let's not do T0, let's do atomic settlement. And then exchanges come back and say, yeah, but market actually needs to have that T+2. How do we deal with that? Well, it's not difficult. All you need to have is liquidity providers that offer you credit lines over that period of time that you need to settle your cash transaction. That already happens, right? That's why exchanges like the ASX has so much collateral, because they need to manage settlement risk, right? And that's the case for every single exchange. So it's really interesting that just by going through this tokenization exercise, I actually think that we apply better principles because of the visibility that blockchains give us towards how we should actually manage risk and structure flows, and the functions of everyone and so forth, right?
Yeah, no, I totally agree. I think, and that's, I just to your point. As soon as we get off chain, we lose accountability and trust, right, in that data. So even the stablecoin, and this is why we've seen various things do, like algorithmic ones where you can supposedly see the collateral, and it has value, that demonstrates on chain. As you said, Cobalt databases are a slightly different scenario right now, but I think it's going to be interesting as we go forward, where we're trying to do the same things. We talk about the asset-backed side and not the payment side, or the other side is going to be an interesting challenge. So I think obviously the reason I say that is there's a lot of worlds where the US being one of them, where a central bank digital currency is perceived as surveillance state, or and or an overreach by government, but I think when we get pragmatically, and in this case I should point out, this is a wholesale level CBDC only. This is not a retail level one, and effectively no one's debating the role of private money in that current stack, right? It's more bringing on chain the Cobalt database that exists at the RBA as to who's got what in their ESA account that they're then backing out. You're now getting effectively visibility, or if you like, in crypto terms, proof of reserves, right through that stack on chain, to be confident that the asset that you're settling in will, as you said, maintain the peg and have the value that you expected. And I think that's why people are kind of taking philosophical standpoints on this rather than kind of pragmatic ones, as to who's backing your money, who's backing the liability or the credit or the no money, as that you've talked about earlier. And so I think we're all excited by a new tech stack and the opportunity to move those things around at scale. But there's these practicalities that I think this project are really going to accelerate the ability to do stuff, because effectively, as we know, there's counterparties that exist through that value stack to provide that trust and or settlement layer. You've just talked about the ASX having a bunch of collateral on hand that either needs to be paid, right, which has to come out of the trading and settlement facility or not, or arguably the RBA provides that directly, and therefore there's no need to have that inefficient amount of capital sitting there. The same as the payment flows, where the troughs of money sit between those counterparties inefficiently for a bunch of time, right? So that's costing someone something. And even the previous project, which I know you ran with the RBA as well, identified $13 billion of annual savings through tokenization. Now that $13 billion dollars annually comes out of the value chain somewhere. So getting people to move forward on that is someone giving up their bonus, which is kind of a bit more challenging to waylay. So it's only when we now get, I think, the asset issuer, and this is kind of core to Redbelly's strategy, the asset issuer to dictate the rails or the stack because they get a better cost of capital, that we really see that shift. And it's only when they do that they want to ultimately connect to all the way to the best cost of capital being retail, fundamentally, rather than all the black boxes that fund those things, venture capital, private equity, banks, along the way. And they kind of, one of the big things in crypto is you are the exit liquidity. It's true in the IPO market, right? This isn't new. This is a new story. And so what we end up with here is a properly democratized financial infrastructure that is, one, operated by the participants of the market, no central rent extracting party taking value out of it, participating. The people using the network own the network, native of the token business model, and then ultimately buying that block space, and then ultimately the asset issuer has best possible global distribution, best possible price discovery to any market, and then ultimately what you also touched on is having AI sit across that to now democratize the financial literacy and or the compliance in the middle part. So now, instead of having a broker or an advisor that I'm also paying to effectively manage my portfolio, and this is the demonstration Vincent did previously using AI to manage, in this case, your superannuation savings, to manage your portfolio of how do I manage you mentioned before, how do I manage the cash that I need or the liquidity that I need versus my capital investments. I want to be able to buy a cup of coffee today, but at the same time, I want to have my capital working as efficiently as possible. Well, you'll be able to flex in and out of those assets with different liquidity in a way more efficient manner for you, so that your money is working maximally for you, and we really pull a bunch of value out of that chain. That's not to say, I think, even self-confessing here, I always thought disintermediation was going to be the way forward, right? We're going to take all these different counterparties out more. That's probably actually not realistic. Those counterparties have been put in for a bunch of reasons, but what we can do is dramatically automate and reduce the cost to serve of those counterparties, so they can still provide their role, but at a more efficient throughput rate and a more efficient cost base, because of the automation that's possible, both from an AI perspective and that removing the reconciliation problem between systems by having a single source of truth. So it's a really exciting example of, to your point, of going from kind of liquidity and payments through to a capital or asset-backed security, and the liquidity that can be provided around that. You really start to understand what a more highly liquid capital market will look like, and what access to these different assets that have previously not been available to all of us to access because it's too expensive or has to be done in big tranches, to now be done in a micro level. We can really see what the future could look like with both AI and a kind of fractionalized, tokenized future. What in your mind is the big unlock here?
I think that the big unlock is the ability to collaborate or compete, and that's a choice. But the central bank has they have more than two, but two of their core priorities is to achieve stability while enabling competition within the economy, and those two things are very important. My thesis is that overall in society we've actually had to give up competitiveness for stability, and that goes across the board. If you see what happened during Thatcher in the UK, right, when competition and openness was the priority, that dislocation created, over the short term at least, a bit of instability. And I think that the reason is because competition, openness, collaboration, inclusivity is much more difficult to manage, right? Because you just have so much more information. And effectively, that's where regulation comes in, right? Regulation is meant to be able to standardize and say, well, if you want to play in this garden, then you need to be able to abide by these rules and be able to come to this level. And not everybody can, which makes it exclusive, which then makes it less competitive, but it brings stability. Right. So at the end of the day, if you have to choose between competitiveness and stability when you're running a full nation, then you have to choose stability. And the same thing also holds for many other big projects, let's say, of human level importance, right? Including multinationals. Now, what we're seeing with these new technologies is that we can actually achieve levels of compliance, levels of standardized collaboration, of robustness, that are easier to achieve because of the technology than with others, which then automatically means that we can expand the number of participants, the types of participants, without necessarily decreasing the quality controls that we have within the ecosystem, right? And I think that's like that's an unlock. That's a societal
I think we
unlock,
can definitely call that big enough as an unlock.
right?
I now feel, yeah, that's amazing, and I agree completely with everything you said. I back to my point about not disintermediation, but really we think about that as commoditizing the services, right? Which is, I guess,
Yeah.
achieved through the competition that you're describing and the access to participate in the markets, right? So I think you're absolutely right that we actually achieve both those things through having a more competitive landscape and by lowering the tech and capital base to participate there. I think one of the things I think about is that big unlock is, when we currently today only 10 or 11% of securities are available as collateral. And so really another massive unlock here is for all the assets that we currently have that we can't access liquidity for, or we can't use as collateral for lending and borrowing, that in a future world will allow people to kind of unlock another level of value and investment for themselves to make their own financial capital working more efficiently for them. So I think they go hand in hand, but I think we're definitely much closer to this future as people are starting to understand changing liquidity profiles and some of the new things that are available in DeFi today, and what that will mean for a more instant and liquid and programmable set of financial relationships. I think it's going to be a massive change. Just finally, because we're just running out of time, the roadmap from participants and scale. I know at Redbelly we've been focused at, yes, it feels like a slow burn because we're not launching a bunch of small DeFi projects every day. We're focused on unlocking big capital flows and selling big network effects. So an asset issuer comes with a bunch of capital, which is what you obviously all index on now, which is the TVL element that we all talk about. But that's just one side of the trade, right? Everyone then starts to look at the liquidity side of that. But the reality is, once the asset investor comes online, they've already got investors as well. So we get both sides of the network effect. We get a bunch of one side of the value and already some investors that need to sign up, getting that network effect. And then we can start to cross-sell or compose across that value chain. That's kind of core to where we're going. But the question, of course, is when and how long. And I know for us, it's been quite frustrating that most of these organizations put their toe in the water and do an experiment, do a process proof concept. I think there's an important distinction here that this is actually a pilot with real money and real participants doing real things. What do you think the path is, or in your crystal ball, the kind of time frame to get to genuine scale from a TradFi perspective, rather than I think what we think about today in scale and or traction from a DeFi perspective?
I am never succinct, so I'm not going to even try this time. And I do want to just set a bit of context here. And yes, it is frustrating because as entrepreneurs, you want to get things done tomorrow or now. But at the end of the day, I think that we need to really take a step back and consider what the hell is it that we're doing. And let's just also remember that banks are running Cobalt code for their mainframes. So that code has not been changed for the past, X number of years. And even when you talk to large organizations that have 90% market share for a specific vertical, even they have difficulty getting their customers to implement an upgrade or buy a new piece of tech. And I think that a really good example is just consider how many organizations are running on the latest version of Excel or the latest version of Windows, right? And it's not going to be all of them, right? And
That's true, but I think
something that is
that's
so commoditized.
it's an interesting example. I think one, you're absolutely right about, well, no one's done an upgrade to Cobalt since the 70s, right? So that tells you
Yeah.
one, the level of risk and or how difficult that is to change out. I think that's true. But the Excel example is also interesting, right? I think when we move to Office 365, i.e., we put people on new rails, those rails being cloud, we do now see that I'm kind of, I won't say dragged along, but imagine that replicates into a protocol basis. We can kind of evolve on an ongoing basis, a continuous software upgrade. I'm sorry if that was stealing your thunder, because that really made that click for me. That Excel example versus Cobalt example is really interesting.
So I think that it's important to kind of contextualize and set expectations right over what it is that we're doing, because at the end of the day, what we've achieved now has been done really fast. We've done that really fast. And obviously we've been building on top of what others have done. I mean, that is the principle. Those are the principles of science, right? But I think that now, going concretely down to your question, what this pilot does is that it sets the stage towards real world the execution of real world trades, and with a pipeline of partners, existing partners, coming partners, we are going to be seeing live flows in the securitization space. I think that even by the end of the year, or by the beginning of Q2, Q3, again, like, even if I say within the next 3 years, that would be an amazing achievement. But I think that we will, entrepreneurs, we're going to get there tomorrow. But it's, what do we have? We have a legal framework. We have real money. Somebody bought a blockchain and it's now working. We have a bunch of different partners that, okay, let me put it this way. The partners that we have are not partners that have a piece of tech that they want to put in place. These partners run securitization flows for a living, and they pass billions of dollars today, and they've been doing so for many years. So when they engage in this pilot, it's not about transforming or capturing a new market, right? It's about making sure that what they do is done better at a much more cost-effective way, in a way also that enables them to grow their business, because many times these operational hurdles stop them from growing, right? So these are real KPIs that we're hitting. This is real business growth for companies that are dealing with billions of dollars, right? So I think that just by the nature of that, the likelihood of execution for our ambitions are so much more credible.
It's interesting. I was talking to one of the trustees that are involved in the pilot, that was talking to us about the revolution here is actually bringing both sides of the ledger into one system. So you've got the asset ledger and the kind of payment ledger brought together. And so, it's one thing to kind of upgrade both sides, but the true innovation here is having that unified ledger of both sides, let alone the look through. And that's why, just wrapping up, I really want to thank you for your ambition in bringing, let's call it the cat herding, that is a bunch of really high profile participants with billions and billions and billions of dollars of flows to the table around this, and making why blockchain and why tokenization, and really creating that unified view that we think is the real game changer for all of financial services to see. I think at the moment, with let's call it level one of what we're seeing in real world assets, is, as we've said, shipping a black box and hoping we're distributing it in a different market to different participants. And that is, to be honest, not working as well as people would like from a scalability perspective, right? Even if you look at the BlackRock Biddle Fund, massive fund held by very, very few users. Even at Franklin Templeton, or in fact BlackRock as well, minimum ticket size is $5 million, right? So these are not retail offers. These are big institutions putting their foot in, dipping their toe into tokenization and understanding what those rails will look like, and ultimately connecting. But what you've done here by connecting fundamentally a retail investor in an instrument right through to a retail use case doing payments, I think is the use case that we all need to see start to finish, in terms of all the different point value propositions being combined into why a new capital markets infrastructure is the way of the future, rather than a bit of noise.
I think that well, thank you, and but also I think that it's very important to acknowledge the role that you guys have played here, because it is a network effect. But on top of that, there are many blockchains, and sure, not all blockchains, and actually no blockchain has the same technical properties that Redbelly has, but it's deeper than that. And I think that it's that not every blockchain acknowledges that it's not about the blockchain. It's about building that infrastructure, and the amount of resources, focus, and impeccable execution that your team has had wouldn't have made without that, this wouldn't have been possible. And that really shows that at least from my perspective, like, it's not called Redbelly blockchain, it's called Redbelly network. And
Great catch.
it's an important thing, because it's not just technology, it's also philosophy and understanding of what we're trying to achieve, right? And I just think that this was a perfect storm in so many different ways, right?
Agreed. And that's before you go layering in your other genius around AI, which we're looking forward to sharing more about that as we go forward,
and privacy
as well. So really exciting. And privacy, don't forget privacy, another commercial confidentiality. With this hyper transparency isn't necessarily commercially advantageous for a lot of people, which is a holdback. So amazing. Thank you so much for your time. We've run over, unsurprisingly, and Mark's come back to give us the wind up. Hey, Mark. Hope you didn't nod off through that, mate. Did you learn something?
Oh, mate, absolutely. And, it's great to be sharing this publicly, finally, because we've been sitting on this great stuff. We've known what the types of things that we can do. And it felt like a little bit like an AA meeting, but for TradFi, because as you said, the first step is acceptance, right? They need to accept that they've got these crap systems. And great to see we're going to talk AI and blockchain. We'll be diving in with more on the project, the partners, and even the community to talk about this kind of stuff. And it sounds like there's really a lot of lessons there that, have just been solved by band-aids in the past. And I think not only are we going to see what blockchains are about, but we're going to lift the lid on what the old systems, how bad they were in a way. So I think the ambition is really good. It's great that there is this collaboration. But to your point, Alan, as you said before, this is very complex type of thing. But I think that with that collaboration and complexity mix, the only way you can solve this is with crypto and blockchain technology. So I'm really looking forward to, excuse the hyperbole, but this really is where we're showing, we will get to show the future of finance. So looking forward to working with you guys.
Very good.
Thanks for dialing in, and we will see you for another episode 12, where, look out, folks. There's going to be more diving deep into Project Acacia and much, much more.
Thanks, Mark.